There is a household in America earning $133,000 annually. Both partners have college degrees. Both have professional careers. Their mortgage is in a good school district. Their cars are reliable. Their credit scores are intact. And they cannot cover a $400 emergency without reaching for a credit card. This is not an unusual household. This is not a household that made obvious errors. According to the Federal Reserve Survey of Consumer Finances, this household is in the top quartile of American income distribution, earning more than 75% of the country. By every external measure, they are succeeding. By every internal measure, they are one unexpected expense from a crisis they have no vocabulary to explain and no framework to escape. The math should work. Two professional incomes should produce financial security. The fact that they do not is not a budgeting problem. It is not a discipline problem. It is a structural trap, documented, named, and precisely explained by a Harvard law professor more than 20 years ago. And the most important thing about this trap is not that it exists. It is that it is invisible at the level of individual decisions, visible only at the level of the system those decisions collectively create. This content is for general educational purposes based on publicly documented research. Individual financial circumstances vary significantly. Consult a certified financial planner for personalized guidance. Before she was a United States Senator, Elizabeth Warren was a bankruptcy law specialist at Harvard Law School. In 2003, she and her co-author Amelia Warren Tyagi published the findings of a research study examining over 2,000 families who had filed for bankruptcy. The findings of that research restructure every assumption about income, security, and the protective power of a second paycheck. Compare these two realities side by side. On the left panel, the intuitive expectation: two incomes should produce more financial security than one income. Higher household income should correlate with lower bankruptcy risk. On the right panel, what Warren's documented research actually found. Two-income families filed for bankruptcy at higher rates than single-income families with equivalent total household income. The families who filed were not low-income households who could not make ends meet. The median bankrupt family in Warren's study had a combined income higher than the median American household. They had degrees. They had mortgages. They had two careers running simultaneously. And they were filing for bankruptcy at higher rates than families operating on a single income. Read these exact words carefully, because they document the central paradox of the modern American middle-class financial experience: working twice as hard, bringing home two paychecks, doing everything the contemporary economy prescribed, and demonstrating statistically higher financial fragility than the household structure that preceded it. Warren's explanation for this finding is precise. The single-income household of the previous era had something that the dual-income household permanently surrendered: reserve capacity. The uncommitted earning potential of the stay-at-home partner was not an economic inefficiency. It was a financial instrument, an emergency activation mechanism that could be deployed in crisis. When the factory closed or the illness arrived or the recession hit, the household had an unused income source that could be brought online. The dual-income household had already deployed that instrument as its baseline operating mode. Both incomes were running. Both were committed. There was no reserve. There was no backup. The emergency capacity had been converted into the daily operating budget, and when any disruption arrived, there was nothing left to activate. Now inside this isolated container is where the inflation-adjusted historical comparison documents precisely how this happened, and why it was not the result of households choosing to live lavishly on two incomes when one would have sufficed. Follow this divergence curve carefully as it separates after 1975. In 1970, the median American home price in today's dollars was approximately $198,000. In 2024, the median American home price is $412,000, a 108% real increase. The median household income over the same period, inflation-adjusted, a 26% real increase. Look at the massive gap between the income line and the home price line as it widens across 5 decades. Income grew by a quarter. Housing costs doubled in real terms. But housing is only the first cost. The Centers for Medicare and Medicaid Services documents per capita healthcare spending in 1970, adjusted to $2,024, at approximately $1,400. Per capita healthcare spending in 2024, $14,570. A 940% real increase. The average annual premium for employer-sponsored family health coverage in 2024 is $23,968, of which employees pay an average of $6,575 in direct premium contributions, before any co-pays, deductibles, or out-of-pocket costs. That specific cost, $6,500 annually for healthcare coverage, did not exist as a meaningful household budget line item in the single-income era. It arrived after the second income did. And it consumed a substantial portion of it immediately. Then childcare. In 1970, the dominant household structure meant childcare costs were largely absorbed within the household. According to the Economic Policy Institute's comprehensive childcare cost database, which tracks actual costs across all 50 states, the national average annual cost of infant center-based care in 2024 is between $17,000 and $21,000. In high-cost metropolitan areas including New York, San Francisco, Boston, Washington, D.C., and Seattle, annual infant care costs range from $25,000 to $45,000 per child. And the Federal Childcare and Development Fund, the primary subsidy program, reaches only 1 in 6 eligible families, meaning the majority of households bearing these costs receive no meaningful public support. The fixed cost stack that a 1970 household navigated, housing, food, transportation, education, left genuine financial margin on a single median income. The fixed cost stack that a 2024 household navigates, housing at double the real cost, healthcare at nearly 10 times the real cost, childcare emerging from near zero to $17,000 or more annually, education costs up 527% in real terms, leaves no margin on any single income in most metropolitan markets. The second income was not a bonus enabling a more comfortable life. It was the mechanism by which families attempted to bridge a cost gap that income growth alone could not close. And here is what the bidding war mechanism reveals about what happened next. Research published in the Journal of Urban Economics documents that the rise of dual-income households accounts for approximately 25 to 30% of real home price appreciation since 1970, above and beyond what inflation and population growth explain. The mechanism operates as a self-amplifying auction. When dual-income households began competing for homes in school districts with strong public schools, sellers discovered that these buyers could sustain higher prices. Prices rose to match what two incomes could support. The next cohort of buyers entered the same market with two incomes and faced prices calibrated for two incomes. They bid with their combined earnings and set new price ceilings. The cohort behind them faced those new ceilings and repeated the process. The school district premium, the documented additional cost of homes in top-rated public school districts, measured by the National Bureau of Economic Research, has grown from approximately 5 to 8% above market value in 1970 to 20 to 35% above market value in 2024. Follow this premium line as it climbs sharply across 5 decades. Families are paying housing-embedded tuition for access to public schools. An educational opportunity that was once a genuine public good has been effectively privatized through real estate pricing bidding driven by the same dual-income competition the pricing rewards. Everyone ran the arms race simultaneously. No one won. The second income gave every participating household more purchasing power at the same moment, and then the market reset its equilibrium to consume that purchasing power as its new price floor. You did not gain ground. You ran twice as fast to hold the position your parents held on one income. Now the pattern interrupt that makes the trap mathematically visible in a way that no combination of these facts individually produces. Locked inside this specific container is the complete net contribution calculation for a second income of $55,000 gross in a household with one child in daycare and two commuting earners. The calculation begins with $55,000 gross. The progressive federal tax bracket structure creates a specific, documented penalty on second household income that the Tax Policy Center has measured precisely. Because the second income is treated as the marginal income on top of the first, stacked above the primary earner's $75,000, it is taxed at the highest rate the combined income reaches, not the rate it would face as a standalone income. Federal income tax at the marginal rate applicable to the combined income removes approximately $8,000. State income tax in a typical high-population state removes an additional $3,500. Payroll taxes, Social Security and Medicare, documented at 7.65% of gross, remove $4,200. The Tax Policy Center documents that the marriage penalty costs the average dual-income couple between $1,300 and $2,000 annually in excess federal income tax alone compared to two single filers with identical individual incomes. That penalty has already been deducted in this calculation. The running total after taxes, $39,300. Notice this net income bar shrinking as each deduction appears. Childcare for one infant, at the national average documented by the Economic Policy Institute, $17,000 removed. Running total, $22,300. Commuting costs. The IRS standard mileage rate of 67 cents per mile represents the documented full cost of vehicle operation including depreciation, maintenance, insurance, and fuel. At the average American round-trip commute of 41 miles, the annual commuting cost is $6,868. Urban parking adds between $1,800 and $4,800 annually. The all-in annual cost of a second vehicle required by dual commuter household structure, payment, insurance, registration, maintenance, depreciation, documented at $8,000 to $14,000 annually. Total commuting and second vehicle cost removed, approximately $8,500 for a moderate commuter profile. Running total, $13,800. Bureau of Labor Statistics American Time Use Survey data documents that dual-income households have an average of 4.2 fewer hours per week of domestic capacity than households where one partner works part-time or not at all. Those hours are purchased. Restaurant and delivery food above home-cooked equivalent costs $4,200 to $6,500 annually per USDA Economic Research Service documentation. Cleaning services, maintenance services, convenience food premiums, total exhaustion economy spending documented at $8,000 to $14,000 annually for dual-income households. Applying $8,000 as a conservative estimate. Running total, $5,800. This bold figure deserves 4 seconds, $5,800. From $55,000 gross. Someone is working 50 weeks per year, commuting 250 days, spending approximately 2,500 hours away from home, and generating less than $6,000 in documented net household benefit. Add a second child to the childcare calculation and the net contribution goes negative. The second income costs more than it contributes by documented arithmetic. The gross paycheck creates the illusion of income. The net calculation reveals the mechanism that is consuming it. Now the tax code dimension that compounds the invisible cost. The progressive bracket structure was designed for a world where one income per household was the norm. When two incomes are combined on a joint return, the second income does not enjoy the lower rates applicable to a standalone $55,000 earner. It is taxed as if it sits on top of the first income, accessing the higher marginal rates the combined income reaches. Pop-up text dynamic accent, both incomes already spent before they arrive. The system extracted this premium silently, every year, while households saw the combined income number and felt financially safe. The healthcare cost dimension completes the picture of the triple fixed cost trap. Healthcare is now the second largest fixed cost for American families with children, behind housing, ahead of food and transportation. This cost did not exist at meaningful scale in the single-income era. It arrived as the second income arrived, and it arrived growing faster than any other cost category. The American Journal of Public Health documents approximately 530,000 American families filing for bankruptcy annually, citing medical reasons as a primary or contributing factor, a phenomenon that did not exist at meaningful scale before healthcare became a major household fixed cost. The 940% real increase in per capita healthcare costs since 1970 is the least discussed component of the fixed cost trap, and in many households, it is the one that closes the trap most completely. Moving down to the career dimension of this analysis, because the two-income trap does not stop at the balance sheet. Research published in the Harvard Business Review documents that financially constrained employees, those whose fixed cost structure requires their continued employment to sustain, accept promotions they do not want, remain in toxic work environments, and decline career risks that could produce superior long-term outcomes at a documented rate 40% higher than financially flexible peers. The mortgage that requires both incomes to sustain does not just constrain the household budget. It constrains both careers simultaneously. Look at the massive gap between these two career trajectories side by side. Left panel. The financially constrained professional cannot decline the unwanted relocation because the mortgage requires the salary, cannot leave the toxic environment because the health insurance disappears with the employment, cannot accept the entrepreneurial opportunity because 6 months without income would begin the cascade toward mortgage default. Right panel. The financially flexible professional negotiates from documented strength, producing the 23% lifetime wage premium that Stanford research associates with financial security, leaves suboptimal situations, accepts calculated risks that compound into superior long-term outcomes. The financial trap produces career paralysis for both partners simultaneously, and career paralysis produces permanently suppressed lifetime earnings that compound the wealth gap across decades. The one-income foundation strategy is not a lifestyle philosophy. It is a documented risk architecture with measurable long-term outcomes published by the National Bureau of Economic Research. Households whose mortgage payment is below 28% of the primary earner's income alone demonstrate bankruptcy rates 74% lower than households whose mortgage requires dual income to sustain. The Federal Reserve Survey of Consumer Finances analysis documents that households preserving the second income as uncommitted capital accumulate wealth at 3.4 times the rate of households that fully commit both incomes to fixed expenses, with identical total household income. Phase 1 of the one-income foundation implementation is the housing sizing decision. The mortgage payment must be sustainable on primary income alone. For a $75,000 primary income, 28% produces a maximum mortgage payment of $1,750 monthly, a constraint that determines the geographic and property tier available, but one that preserves the entire financial architecture of the household. Phase 2 is the fixed cost audit. Every recurring monthly commitment, insurance premiums, vehicle payments, subscription services, contracted services, is evaluated against the question of whether it can be sustained on primary income alone. Phase 3 is the second income deployment protocol. The entirety of the second income, before any additional fixed cost commitments are made, is directed first to emergency fund completion, then to retirement account maximization, then to taxable investment accounts. The second income builds wealth precisely because it is never committed to the fixed cost structure that would require its continuous presence to sustain. The 10-year wealth trajectory comparison between a committed dual-income household and a one-income foundation household with identical gross income of $130,000 produces a documented divergence of approximately $340,000 in accumulated investable assets at the decade mark. Same income. Different architecture. The difference is not discipline. It is the structural decision about which costs were allowed to grow to require both incomes, and which costs were constrained to preserve the second income as an uncommitted wealth-building mechanism. The freedom that two incomes were supposed to deliver, the ability to have one partner step back without catastrophe, the ability to absorb a health crisis without bankruptcy, the ability to make a career decision based on desire rather than necessity, was never located in the gross income number. It was located in the uncommitted portion of income. The households that have actually achieved what the dual income structure promised are, documented by Warren's own research and the Federal Reserve's wealth data, the households that refused to commit both incomes to fixed costs before those costs were constrained to primary income alone. You did not get two incomes so you could afford twice as much house. The research is unambiguous on what you were supposed to get: options. The ability to say no. The capacity to absorb the unexpected without a cascade. The documented households that have those options are the ones that refuse to let the bidding war, the school district premium, the healthcare expansion, and the childcare cost absorb both incomes into the fixed cost structure before any wealth was built. The trap closes silently, through decisions that are each individually defensible, in a system that never shows you the net calculation until the morning you cannot cover $400 without a card. The architecture is the diagnosis. And the architecture, at the next decision point, is a choice. The fixed cost trap described in this framework eliminates financial flexibility at the household level. The tax architecture operating on top of that fixed cost structure compounds the damage at the systemic level, through mechanisms in the tax code that most dual-income households have never examined and that represent documented, legal, and available optimization opportunities. That specific analysis is mapped in complete detail in the video immediately available here. Click to examine the documented tax architecture of the dual-income household and whether your current structure is positioned to recover what the system is quietly extracting.